Hello everyone, welcome to today's video. In today's video, we are going to discuss about the risk from the risk return analysis. So in this video, we're going to check the types of risk, the risks involved in investment in government securities, the components of risk, and the measure of risk. Let us start our video here. Under types of risk, a risk can be of two types. One is systematic risk and another type is unsystematic risk. So first of all, so when we were discussing about systematic risk, we will be also seeing what are the types of risk involved in systematic risk, which is market risk, interest rate risk, and purchasing power risk. Similarly, we will be also discussing about the different types of risk under unsystematic risk, that is business risk, financial risk, and default risk. So let us start with what is meant by systematic risk and unsystematic risk, which is micro level concept, and within that we will be checking what are the other kinds of risk. Here we have just bifurcated systematic risk and unsystematic risk in a differentiated format, so it will be easy for us to understand. So systematic risk is a risk which arises out of external and uncontrollable factors. We don't have any control over that risk. So it is not specific to a security or industry. It's going to affect overall, and it cannot be eliminated by the diversification. The very important point to be noted is systematic risk cannot be eliminated by the diversification. So the risks involved in systematic risk are market risk, the interest rate risk, and the purchasing power risk. When it comes to unsystematic risk, it's exactly opposite. The unsystematic risk arises out of known and controllable factors. We can control it, and it is specific to a security or industry, and it can be eliminated by diversification. So the risks involved in unsystematic risk are business risk, financial risk, default risk. So let us just see what are these risks with some examples. So risks involved in systematic risk. First one is market risk. What is a market risk? So these risks are triggered due to social, political, and economical events. For example, if there is any circular from the government and that circular is going to affect the investment of the stocks, overall the market, then it is considered to be market risk. Example, increasing the capital gain taxation or the short-term holding of your capital gain taxation, etc., considered to be a market risk. Because of this increase of the taxation, there will be a change in the pattern of the investment, so which is considered to be a market risk, right? Yes. So coming to interest rate risk. So interest rate risk is a risk where there involves an uncertainty of future market value, and due to which the income which we have been calculated that I might get this amount of return might be affected. So that is considered to be an interest rate risk. So these risks arises due to fluctuating rates of interest. So the final type is purchasing power risk. Under purchasing power risk, there will be an erosion in value of money due to the effect of inflation. So the amount of the value is going to be differ even though the value is at the same time. So these are the risks involved in systematic risk. So in short, here in the screen I give what is a market risk. It's a social, political, and economical events, and interest rate risk or due to the fluctuation in the interest rate, and the purchasing power risk is due to the erosion of value of money called inflation. Now let's check what are the risks involved under unsystematic risk. So under unsystematic risk, there are again three types of risk. One is business risk, and another one is financial risk, and the last one is default risk. Let us check what is a business risk. So a business risk is a risk which involves the volatility in revenues and profit. So due to something is happening, the business revenue or profit will be affected. In that case, it is considered to be a business risk. It is. So now you can see, obviously you can see it is a sector specific, it is a business specific. So it's a controllable, so it's unsystematic risk. And when it comes to financial risks or those risks associated with the capital structure of the company. So example, the company is having lots of debt financing. So when it comes to the leverage, the financial leverage is higher. So in those cases, there is a financial risk. So to be kept in mind, if there is a higher financial leverage, then there is a higher financial risk, and if there is no debt financing for a company, I just invested everything or I just took everything from the capital and there is no debt involved, then that company is having zero financial risk. And when it comes to default risk, what is a default risk? Default risk is something which organization or a business is not meeting their obligation. So there is obligation to pay an interest, but this company didn't do it at the time, so they default and meeting the financial obligation on time. So because of which the bankruptcy cost might increase. So these are the risks. So now we saw two types of risk, that is systematic risk and unsystematic risk. So this is not controllable and this is controllable. and these are exist due to external, and this is something due to internal. And if you see, there are three types of risk involved. One is market risk, another one is interest rate risk, and finally there is purchasing power risk. When it comes to unsystematic risk, again there are three risks. One is business risk, then it's a financial risk, and finally it is a. So now we are done with the types of risk, which is systematic risk and unsystematic risk, and the subtypes of risk. So that's all for the today's video. Thank you for watching.